Hi there. In this tutorial, we'll be learning about the basic features of stocks. We'll begin with understanding how stocks help you gain ownership in a business. We will distinguish between common stock and preferred stock. Then we'll talk about stock prices and returns. And at the end, there will be some true-false questions for you guys to test your learning. Okay, let's get started with the ownership aspect. So here in the figure, we've got the balance sheet for a company. On the left-hand side, we've got the assets, and these assets are owned either by debt holders or equity holders. In a previous lesson, we had talked about bonds. So bonds would fall into the debt category, whereas stocks would fall under the equity holders category. So it is really the shareholders who own the business, but what we say is that shareholders have a residual claim. And this is quite important. So this means that the equity holders or the shareholders own once debt holders are fully paid. So what is left once these guys are paid? So this means that they don't have claim on the entire assets, but the entire assets left after you pay all your debt obligations. And this is an important point because the value of assets change over time. So sometimes this value would increase, right? So for example, we add some value here, and here the value of debt won't increase because this is fixed. So that means that actually the value of equity will increase in parallel with the growth in assets. So equity becomes more valuable. Again, it's a residual claim, so the debt part is fixed. So if assets grow in value, equity also grows in value in parallel. But this is a good scenario. How about a bad scenario? So for example, imagine a scenario where actually the assets do not grow, but instead they shrink. So let's say we start with this whole rectangle, but the assets shrink to this red rectangle. Now the value of equity has shrunk substantially. So it's only this part left, right? Because this is the residual claim after the debt holders are paid. So if the business does great, equity holders do great as well. So they basically benefit from the upside potential. But when the business does poorly, debt holders still have the priority, and equity holders need to be basically content with whatever is left for them. And in the worst case scenario, sometimes nothing is left for them, right? So if the firm's in real trouble, then the assets might actually shrink a lot more. So then in this scenario, for example, if the firm goes bankrupt, everything goes to debt holders and nothing is left for equity holders. But that's more of a very bad scenario, which hopefully often won't happen for most of, let's say, high-quality corporations. In such a scenario, stocks will be valuable and they will entitle shareholders to various rights, right? And this is due to their ownership. So primarily, they will have two types of rights. One is the voting rights. Okay, so as a shareholder, you will have voting rights, and this will be specified based on the type of shares you have, which we will talk about more. And you will also have cash flow rights. Okay, and cash flow rights, of course, will be based on this residual claim and the dividend policy of the company. And also, at this point, it is worth highlighting that many corporations will have different classes of stocks. So not just one type of share, but they will have different types of shares. In the next slide, we will distinguish between, for example, common stock versus preferred stock. Okay. But even within common stock, you can have different classes. So for example, you can have class A, class B, C, and so on. And typically what varies between these classes is voting rights, which is the one we mentioned here. So for example, certain class of shares might have substantially more voting rights than others. And you might wonder why this would be the case. This is basically a mechanism for entrepreneurs to maintain control of their companies after taking them public, right? So the pre-IPO owners will typically retain the class of shares with higher voting rights. So this could be something like, for example, 10 votes per share, whereas, the retail investors, when they buy shares, perhaps they buy Class B shares, which might have, let's say, 1 vote per share. Then, of course, in terms of voting rights, Class A shares are 10 times more valuable compared to Class B shares. Now, let's move on to the distinction between common stock versus preferred stock. And there are quite a few differences. The first thing to understand is that preferred stock is sort of a hybrid security, which sits somewhere between common stock and debt. So again, common stock gives you ownership, right? A residual claim, whereas debt holders in normal times, they don't have ownership, okay? No ownership. And they only gain ownership of the business if the business goes bankrupt. Then they take over. But otherwise, the company will be owned by the common stockholders. And preferred stock, like I said, sits somewhere in between. And it's sort of a hybrid between the two. And you can see the differences in various aspects here. So, for example, common shares, like we discussed before, would normally have voting rights. Again, there might be different classes. So let's say Class A might have 10 votes per share, B might have 1 vote per share, and so on. But the preferred stock won't have any voting rights. So in this sense, it resembles debt, because also debt holders, when the business is not running normally and the company is meeting its debt obligations, these guys don't get to vote on company matters. And typically in corporations, there will be matters to vote. And for example, on an annual basis, there'll be an annual shareholder gathering and so on. You'll be voting on many matters, including, for example, top management, which run the company on your behalf, right? And in terms of dividends, so dividends are quite important for stocks. Of course, it's an important cash flow for shareholders. Preferred stock has a better structure here, a safer structure, because they are paid fixed dividends. So it's a bit like, again, resembling debt, because if you think about a typical corporate bond, it would make coupon payments. And preferred stock has the same structures, that there will be a fixed dividend. And in fact, if a company misses to pay a fixed dividend on preferred stock, this would often be cumulative, in the sense that the next time around, the company will have to honor both the current preferred dividend and the one that was not paid before. Whereas there's no such promise for common stock, so the dividends are variable and not guaranteed. So the company is not under obligation to pay dividends unless they have been announced. Okay, so in those cases, they pay nothing if they want. Whereas with preferred stock, there is a fixed dividend structure in place. So you can see that both in terms of voting rights and dividends, preferred stock is closer to debt. And if things go bad, if the company goes into liquidation, remember that debt holders are paid first, so they have the priority. Common stockholders, the shareholders, are paid last, so these guys are paid last, debt holders paid first, and preferred stocks owners basically are paid before common stockholders and after debt holders. Okay, so ahead of common and behind debt. Okay. How about the risk return profile? For all of these reasons discussed earlier, of course, preferred stock has lower risk, right? Why? Because they get the owners get fixed dividends, and in terms of liquidation, they have priority. But on the downside, they have limited upside. If the company experiences stellar growth, these guys would still get their fixed dividends, whereas the common shareholders will be really benefiting from the higher return potential. So basically, compared to preferred stock ownership, common stock ownership is a higher risk return scenario. And sometimes preferred stock might have special features as well. So, for example, these shares could be convertible in the sense that the company may convert preferred stock into common stock. Okay. Next up is stock prices and returns. This is quite a big topic. I'll just give you flavor of the basic concepts here. So first of all, like any asset, the price of a stock depends on its present value of its future cash flows. So in this case, the future cash flows are dividends. So at any time t, the company may pay a certain amount of dividend. Then basically we need to discount it at a risk-adjusted rate, okay? And there will be a stream of these dividends. So the stock price will be simply the present value of all these future stream of the expected dividends. Okay, so this is the logic, let's say basic logic behind stock valuation. And also, given that we are talking about dividends and stock prices, it's also important to distinguish between the two key components of a stock's return. So to explain that, we need to think about a stock's total return. Okay, so the total return of a stock consists of capital gains. So this is the appreciation in the stock price and the dividend yield. Okay, dividend yield. Of course, if the firm is not paying dividends at the moment, dividend yield would be zero. So the total return would be determined only by capital gains. So for example, if you want to compute the capital gains, so for example, at PT minus 1, so you would look at the current price at PT, subtract PT minus 1. So this is the growth in price, right? So this is a component of the total return that comes from the changes in price, and the dividend yield component would be basically the dividend paid at time t divided by PT minus 1. Okay. And what analysts do usually when they want to value stocks, a couple of approaches. They could employ relative valuation, looking at peers, or they can do what we call a DCF valuation, so discounted cash flows, focusing on either the dividends or the free cash flows of the company, making certain assumptions about, for example, the dividend growth rate and so on. I would like to give you also a real-world example here, just to make the ideas more concrete. So let's look at the share structure of Alphabet Inc. Incorporated, and this is really the parent company of Google. And as you can see, they have different classes of shares, and these are all common shares, and this is what I was telling you before. So for example, Class A shares, these have only 1 vote per share. Class B shares have, for example, 10 votes per share, and these are primarily held by the founders of the company, who are Larry Page, Sergey Brin, and Eric Schmidt. And these shares are not publicly traded, so this is basically a mechanism for these guys to have more say in the business of the company. And there's also a Class C shares with no voting rights as well. And at the time of this video, the market cap of Google was nearing $3 trillion with more than 12 billion shares outstanding. So this hopefully gives you an idea about the scale of the share structure. And here we've got a number of true or false questions for you to check your understanding. If you look at the video description, you will find a link to the answers, so feel free to check that out as well. And the last thing I would like to say in this tutorial is that if you've liked this tutorial, which I hope you did, I would recommend you to check the one on bid prices and ask prices as well, because when trading in stocks, or investing in stocks, when doing these purchases via your broker, you will see 2 prices quoted, and one of them will be the bid price and the other one ask price. So this tutorial explains how that works. And like I said, I hope you've enjoyed this tutorial. If you got questions, feel free to leave a comment below, and I will be looking forward to see you in another tutorial. So bye for now.